What I really want to point out here, this is 40.3%. And if you go across here, here's 37%, so very close to it. But then 1979, 1974, 73, 72, this first part of the bull market. Now, this was only Western Europe and Canada. It was still illegal to own gold or trade gold in the United States. This is this is some spectacular performance, but what this is saying is that the best is yet to come. We haven't even gotten started yet, folks. So James Anderson, my friend James, we worked together for many years. James started at GoldSilver.com many years ago. 39% of fund managers surveyed are gold broke. That's 39, and it looks like it was about 41 or 42. It's 39, so these people that have no gold whatsoever, these fund managers.
The first time since 1996, foreign central banks possess more gold than U.S. Treasuries. This single data point changed world monetary history, not only a symbolic milestone, a basic trust repricing. Central banks held U.S. debt for decades, considering treasuries the safest asset, but that age ends. As Mike Maloney notes, the transition from paper promises to solid reserves is not simply a diversification, but a wholesale reevaluation of real money in a world losing faith in fiat systems. Gold comprised 70% of central banks' foreign reserves in the 1970s. After years of accumulation, that number is still near 15%, meaning there's huge expansion potential if central banks continue their historic buying. Central banks added 1,037 tons of gold in 2023, the second highest annual total on record, according to the World Gold Council. Since 2021, the same entities have sold almost $900 billion in U.S. Treasury securities. This reversal has huge significance. Gold, which the government cannot print, has become the only universally trusted store of value as dollar confidence declines and budget deficits rise. The calculation predicts a gold price several multiples above present levels if world reserves return to the 1970s average of 40 to 50% gold backing. Just raising the allocation from 15% to 30% would require tens of thousands of tons of gold, achievement that would strain supply systems, drain Western vaults, and cause a price increase no futures market could handle. A long-term repricing event like this changes the global asset hierarchy. What follows gold impacts silver always. Silver, gold's partner, becomes the leverage play as the monetary system returns to actual worth. Industrial demand exceeds mining supply. Maloney notes that the market consumes more silver every 6.8 minutes than miners create in roughly 10. Balance cannot be maintained without a drastic repricing. Today, Mike Maloney links this astonishing central bank reconfiguration to gold and silver's profound undervaluation, explaining why we may be at the verge of the biggest precious metals revaluation in history. Peter Schiff later explains how record-high stock market figures hide a deteriorating reality when assessed against honest money. Before we begin, please like this video, subscribe to our channel, and comment below. Please enjoy the video, and thanks for supporting us.
Or the other thing is that enough miners can go out at these, we need some astronomically high prices to cause a silver rush of miners to open up new mines. Tavi Costa points out that foreign central banks now officially hold more gold than U.S. Treasuries for the first time since 1996. Let that sink in. If you think this buying streak is ending, just look at what happened in the 70s. This is likely the beginning of the most significant global rebalancing we've experienced in recent history. You need, Tavi, you need to drop the word recent out of there. In history, period. Here's another gold update. Ryan Dietrich shows this great chart. Gold is up 40% in 2025, its best year since 1979. But what I really want to point out here, this is 40.3%. And if you go across here, here's 37%, so very close to it. But then 1979, 1974, 73, 72, this first part of the bull market. Now, this was only Western Europe and Canada. It was still illegal to own gold or trade gold in the United States. This is this is some spectacular performance, but what this is saying is that the best is yet to come. We haven't even gotten started yet, folks. So, James Anderson, my friend James, we worked together for many years. James started at GoldSilver.com many, many years ago. 39% of fund managers surveyed are gold broke. That's 39, and it looks like it was about 41 or 42. It's 39, so these people that have no gold whatsoever, these fund managers, and I love this, money managers who don't know the first thing about money. They don't, because they're not buying money. They're invested in things that are everything's measured in currency to them. So 39%, 20% of them have 4% gold exposure, 16% of them 2%, 8% of them have 6%, and 6% of them have 8% or more. Only 6% have 8% or more. And I guarantee you there's going to be a day where all of them are going to have some exposure, and it's going to be at least 10%. Money managers, I don't know if they had these funds then, but brokers and so on, they didn't recommend gold back in the bull market of the 70s. It wasn't until after it was too late that they started recommending, put 20%, 25%, 30% into gold. And then that became less and less and less until it's, just 10%. And then it basically, by the year 2000, when gold was just $250 an ounce, they're saying don't put anything into gold because it's dangerous. You could lose. And because they want to sell you their products. And then you hear this fallacy of, just put 10% into gold because gold is so volatile, it's dangerous. Well, it's been the best performing asset of this century, other than cryptos, but when you start at zero, from 0 to 1 is an infinite return. Bar charts created this wonderful chart, and they were saying gold hit the most overbought level on the monthly chart in 45 years. Now, I tried to duplicate this chart, and notice it goes back to 79. I went back a little further, and I found something very interesting. If you go back further, first of all, it's not as overbought on the MACD that I was able to generate, and this is on a monthly, it's not quite as overbought, but it is in seriously overbought condition. But look at the first part of the bull market. Now, I'm going to zoom up on this a little bit more, the 70s bull market. So we are not yet as overbought as we were in 1980. So it would actually be good for gold to go sideways for a month and work off this overbought condition. But I'll tell you, none of this matters in a currency crisis. Gold will just continue going north and get more and more and more overbought, and it has nothing to do with the situation. It does not matter. Here is the entire bull market of the 70s, and this is only Western Europe and Canada driving the price. It was illegal for Americans to own gold. It was illegal for Australians to own gold. For Americans, until the first day of 1975, Australians the first day of 76. But the first day of 75, it started falling. Why? There are probably two reasons. One reason, the gold nationalization of 1933, when Roosevelt nationalized gold, he did not confiscate it. When you hear somebody use that word, it's usually some dealer trying to move you into an overpriced collector coin from bullion, because bullion has these minuscule profit margins on it. So I believe it was 73% of all of the gold coins that were in circulation were not turned in to a member branch of the Federal Reserve System, which is what the instruction on Roosevelt's executive order said. And so they remained in private hands in hiding, but you couldn't do anything with them. You couldn't sell them. And so people sat on those coins for 50 years. So they were passed down from father to son, maybe from father to son to grandson. Who knows? But after sitting on them for 50 years, they were $35 an ounce. Gold had gone from 35 to just under $200 an ounce. And so all that gold that had been hiding in safes and shoe boxes and under the mattress for all those years comes out of hiding and gets sold into the market, and it falls down to 103. Simultaneously, there was a crash, the stock market crash in 74, and then it started to bounce out of it in 75. So the stocks are outperforming gold, but by September of 76, it turned around and went from 103 to 850 on the close, 873 intraday, and coincidentally, the Dow was at 873 points at the same time. So 1 ounce of gold bought the Dow. So that's a picture of the bull market of the 70s. If we zoom up to the 1976 bottom at 103, you can see that gold right at around just below 400. It went past it, but then sort of stalled and went sideways. And that was October and November. And then in early December, it took off again. So during this time period, it worked off some of that overbought condition and then got overbought again. That was this area right here. But once it passed that previous peak, it was just off to the races. And there's only about, I can't remember how many trading days there is. There's holiday, Christmas, it's closed Christmas, New Year's. And so it wasn't very many trading days.
When Maloney uses fund manager exposure data, the story becomes clearer. Gold has outperformed nearly every asset class this century, but 39% of institutional fund managers have no gold exposure. Amazing paradox. Professionals managing trillions of dollars are neglecting the asset that outperforms stocks, bonds, and most commodities since 2000. The causes are cultural and structural. Most fund managers are educated to benchmark performance in fiat currency, not actual value. History reveals what occurs when sentiment changes. After the bull market began in the 1970s, mainstream portfolios increased gold allocation from near zero to over 20%. Maloney's announcement of repricing is straightforward but important. Silver, already under physical pressure, will follow gold with increased volatility and upside potential when money managers re-enter the gold market and the demand shock collides with years of underinvestment in mining and processing infrastructure. This is the preamble to Peter Schiff's part on how pricing assets in real money, not paper dollars, destroys the illusion of wealth based on inflated stock prices.
The main problem with the government shutdown is that they don't shut enough of the government down. I mean, most of the government is still up and running. So if they shut down the whole thing, I can get behind that. That might be something worthwhile. But unfortunately, most of the government is still operating, except some of the things that you might want to operate. Although if you're in the process of being audited by the IRS, like me, there is a pause, right? They can't audit you because they can't pay the agents, so that's on pause. Although my FOIA lawsuit, I'm also suing the IRS, which is probably why they're auditing me. But the government got an open-ended extension now to reply to something I filed because of the shutdown, right? Oh, they're not allowed to work, so somehow they've got this open-ended reprieve. So it works both ways. They paused my audit, but now I got to wait longer to get what I'm looking for from my FOIA lawsuit, right? Because I'm suing them because they should have produced the documents that I requested and they didn't do it. So now they forced me into court. And now the process, which has already taken forever, is delayed even longer. by the shutdown. But the first problem is they don't shut down enough. Like maybe they shut down the national parks or stuff like that. But we all have to keep paying taxes, right? They keep taking taxes out of your pay. All the rules and regulations are not suspended, right? So we still have to deal with big government, even though it's supposedly shut down. But the other problem I have with the government shutdown is that they always end it and they reopen the government. So, I mean, we know it's coming back. I mean, if it was a permanent government shutdown, a lot more people might support it. But it's never permanent. It's all just theatrics. And apparently, the big sticking point is that the Democrats want to renew these subsidies for Obamacare that were put in during the COVID emergency, right? So it was a temporary relief because of COVID, and supposedly everybody was, earning less money during COVID, when the fact of the matter is most people earned more money during COVID, right? So to say that people needed special help with their bills, why would they need help? People weren't even paying rent. They weren't making payments on their student loans. And a lot of people who were not working during COVID were getting stimulus checks from the government that exceeded what they used to earn. So people had a windfall. People just went on a shopping spree during COVID. So the idea that they needed this extra help with their medical bills was just a bunch of BS. But anyway, this stuff was put in there as an emergency. Now, of course, the COVID emergency is gone, right? I mean, and in fact, it was a contrived emergency. The government made the whole thing up. I mean, they didn't make up COVID, but they made up the overreaction to COVID and the shutdown of an economy that didn't need to shut down. Look, Sweden didn't shut down, and the Swedes were fine, right? We should have done what Sweden did. In fact, I said that at the time, right? And you could have gotten deplatformed for saying something like that, right? Because everybody had to, keep up the line that we had to do this, because if you question the official narrative, you were somehow an enemy of the state, and you couldn't be allowed to speak because people might actually listen to you. But this is how government works, right? They get something in. Oh, it's an emergency. We need this. But now the Democrats are saying, well, because people have had it for so long, they can't live without it. Or we can't take this away. That will create a problem because, see, people are now dependent on this subsidy that we gave them during the emergency. And so now because they're dependent on it, it has to be permanent, which in and of itself shows you why you shouldn't even do this stuff, because the government creates the cycle of dependency, right? You make somebody dependent on your handout, and now it has to be permanent, right? So everything that's temporary in Washington becomes permanent. So at least the Republicans somehow, after all the reckless spending of the big beautiful bill, this is a bridge too far, right? This extra, they're claiming it's $1.5 trillion, I guess over, I don't know how many years they score it. But they're saying, no, we draw the line here. So we're going to shut down the government rather than spend this money. Now, I wish they would have shut down the government instead of passing the big, beautiful bill. I wish they would have vetoed, or Trump would have vetoed, the increase in the debt ceiling that he demanded as part of the big, beautiful bill. So that would have been a worthwhile shutdown. I mean, this isn't going to change anything, right? It's like, the Titanic is still going down, and they're talking about, where we should have the deck chairs, right? Doesn't really matter, man. Maybe, the Republicans think that this is too many deck chairs. Doesn't matter. That the ship's going down. So you're arguing over nothing. But who knows how long this government shutdown is going to last. But I think the Trump administration is probably happy that the government shutdown prevented the jobs report from being released, because I'm sure it would have been bad. In fact, we did get one jobs report earlier in the week, the ADP report, because that's, a private report, so it's got nothing to do with the government shutdown. So that came out on Wednesday. So we got that. I'll talk about that. So the expectation was for 50,000 jobs pretty low bar. But not only did they not meet that bar, they were well beneath it, because we actually lost 32,000 jobs, according to ADP, in September. And worse, they went back to the prior month, which was originally reported as plus 54,000 jobs.
Peter Schiff's simple collapse is tragic. Dow and S&P headlines celebrate historic highs, while gold prices tell a different story. The Dow Jones has plummeted almost 30% in gold terms in the previous 2 years and roughly 70% over the last quarter century. The illusion of growth is caused by currency debasement, not production or innovation. Dollar purchasing power declines. However, investors are persuaded they're wealthy since their nominal account balances rise. Schiff's framing breaks this illusion. The Dow has been in a naked market for decades and honest money. Maloney and Schiff agree on this. The world is about to discover that fiat-based wealth creation is a mathematical mirage in the global financial system. Central banks buy gold and sell treasuries because they know this. Private investment will follow. It will not be gradual when price discovery occurs. Real assets repricing against decades of paper inflation will entail a dramatic structural reset. This might support gold prices above $4,000 per ounce in the medium run, with exponential repricing if monetary skepticism grows. Silver dynamics are considerably more explosive. According to Maloney, considerably higher prices are needed to reconcile usage and output because supply is chronically below industrial demand. Silver will likely start a self-reinforcing rally as investors, producers, and sovereigns struggle for declining physical supply when it exceeds its equilibrium level. From the Genoa Conference of 1921 to Bretton Woods' collapse in 1971, every major monetary transition has featured a return to physical value after over-leverage and credit expansion. We may be seeing the modern equivalent. Promise-based settlement returns to real assets. This time, gold and silver will benefit in ways we have never seen. The message from Mike Maloney and Peter Schiff is clear. Repricing has begun. Whether you position yourself before it gets mainstream is the only question. If this analysis was helpful, like this video, share it other precious metals market watchers, and subscribe for more expert breakdowns as this historic changeover occurs. Thanks for watching, and prepare for real money's return.